Okay, good day everyone. This is Capitaland Investment Limited Annual Report 2023 dated 1st April 2024, recorded on 26 November 2024. This is my first look at this company, so pardon me if I make mistakes. Right, again, this is the 2023 Annual Report. Right, their core markets are Southeast Asia, China and India. Alright, so you can see that Southeast Asia including Singapore is 41% of REAUM, which is real estate asset under management. Right, China is 34% and India is 4%. Alright, so this forms their core market. Focus markets, I believe Japan and South Korea should be under other Asia. Okay, I'm going to assume Australia is also under other Asia, whereas the non-Asian market is, I think, UK, Europe and US, which is the smallest part of the pie at 9%. Right, so REAUM is actually the total value of the real estate managed by the group, stated at 100% property carrying value. Right, so this means to say that, for example, if they only own 20% of this building, right, the other 80% might be owned by someone else, but they count the whole 100% as under REAUM, right, because they're actually managing the whole asset. Right, then there's another part of their business called FUM, right, which is fund under management. Right, so this refers to the share of total assets under CLI, listed funds and unlisted funds. Right, so it includes all their private funds and so on and so forth that they own. Right, it's not very far away from this percentage. Right, 42% for Southeast Asia and Singapore. China is 31%, India is slightly higher at 7%, and so on and so forth. Right, basically CLI is the investment arm of Capitaland Limited, right, because they got listed in 2021 after the merger with the development business, so they are not in the development side of the business. Right, so what they actually do is actually they do investment management and fee income growth work to unlock more shareholder value. Okay, so they actually started, of course, as a Capitaland Limited about 20 years ago, where they listed Singapore's first two REITs. I know one of them is, at that point of time, Capital Mall Limited. It was the first REIT in Singapore. I'm not sure what the second one is. Could be Ascendus. Actually, I don't think Ascendus was under it yet. So that means it could be the Capital Mall, not Capital Mall, but the Capitaland of office side. Right. The second one, I'm not very sure. Don't quote me on that. Right, so today they have 6 listed funds across Singapore and Malaysia. We'll talk about that later. And that's only part of the portfolio, because they also have the private side, right, the private fund side, which has 30 private vehicles. Right, so they have $100 billion of fund under management, right, as we've discussed earlier. Right, and also the real estate assets under management side is 134 billion. Right, so we have it here. Right, we talked about distribution there. Right, we look at their business model. They split into two. They call it fee income related business, or FRB, versus the real estate investment business, which is REIB. Right, so I believe this one is when they, whether it's listed or non-listed, when they have the property, right, they actually manage the property, they try and grow it. I believe that when they buy and sell, they also make money off the management fee in buying and selling. Right, and of course, managing the assets itself is a very good recurring income source. Right, so I think they separated into listed, private, lodging management, which I think is the hospitality side, as well as commercial management, which I believe should include everything under the REITs, which are like I suppose malls, office and logistics. Right, so we look at the FY 2023 performance highlight. Revenue is slightly lower, revenue under management is slightly higher. Alright, total PATMI dropped very significantly, but we'll see that it's not as bad as it looks. Right, we'll probably look at operational PATMI more. Right, there's a slight drop. Right, portfolio gains are actually there's actually portfolio gains, right, but it's a lower gain than in FY 2022. Right, so they say it's a challenging year because of the macroeconomic and geopolitical challenges. Right, and within the fund management sector, the rapid rise of interest rates to combat inflation, both are problems that I think hasn't fully alleviated, has impacted capital flows globally, bringing global private equity fundraising to 6-year lows. Right, dampening property demand and valuations, right? So they haven't done well in 2023 as a result, right? They have a target to move their fund under management to 200 billion over the next 5 years. I believe this is on top of the 100 billion they already have currently. So that means to say it's not an additional 200 billion, but it's an additional 100 billion, which means 20 billion a year, right? Initially I thought it's 200 billion increase, right? But I think it's 100 billion increase over the next 5 years instead. Right, so anyway, we'll just try and explain their PATMI here, right? So the operating PATMI is down 7%. I think this is a more accurate reflection of their results, right? Portfolio gains down 4%. Cash PATMI is down 6%. This is where all the money actually disappeared from the profits, right? So the total PATMI is actually down significantly by 79%, but mostly it's due to this $600 million revaluation of property. So it's mostly non-cash item lah. So the property are the same, just that they got revalued lower. They have to recognize it in their accounting statement, right? So you can look at revenue by business segment, right? FRB is 38%, REIB is 69%, right? I believe there's some overlap because somehow this is above 100%. You look at total revenue by geography, right? China looks quite big and scary when you look at this. It looks like 34%, but if you look at revenue wise, China is quite small, even when you include Hong Kong at 16%. Right, Singapore is 20%. All right, the rest are quite it's quite hard to tell what's inside this lah. They didn't really break it down. All right, we look at revenue from the FRB and the REIB side. All right, we look at we can see that FRB has dropped slightly. All right, and REIB, if we look at operating, has also dropped slightly. All right, this one I think is due to the revaluation. Right, by geography, we can see that Singapore has also underperformed. Right, actually everything has underperformed. Right, except the other emerging markets. Right, we look at the fee income related business. Right, so this is the FRB business. Right, you can see that listed fund management is up 5%. Private fund management is down 23%. I think it relates to what they talked about in the challenging year earlier. Right, lodging management, they seem quite proud of this. They discussed it quite extensively, up 28%. Commercial management is up 11%. Right, this one is, I think, mostly due to just managing the REITs. Right, fund under management has gone up overall, all in FRE and FUM. Right, I believe that this is, as I understand it, the fee related earnings including fund management, commercial management, lodging management fees from the listed and private funds, right, computed based on the average FUM deployed for the year. So I think this is the percentage of fees they take from the assets that they manage, right? So this is 78 BPS is 0.78% fee. Right, that has improved to 81% fee, not 81% fee, 0.81% fee, right? So it's less than 1%, right? But whether that is expensive or not for the management of the properties, I think you can decide, right? So real estate investment business, the revenue has dropped 9%, right? And the EBITDA, if you look at the revaluations, right, obviously it has dropped quite significantly. Right, so anyway, assets wise, we've talked about this roughly. Total asset by geography, right, you can see Singapore 30%, China 30%, right? But if you think about it, China's revenue is quite small, so it's not as I would take China as 16% of the business, right? Because I'll value it by revenue, right? But that brings into question whether or not the valuations here is accurate or not, or is it more revaluations are to come? Right now I'm not very sure, right? So I'll just have a look at their revenue, right? Improve a lot from 2021 to 2022, could be due to COVID, right? And then there's a slight dip this year, we are aware already, right? Not too much to say here. You can see net debt over equity, right? So it's quite a lot of leverage used in this company as well. It's gone up slightly. Right, debt maturity this year, 1.2 billion to refinance, right? I think this part is a concern, right? Whether or not the refinancing right? Quite a lot of the debt is due 2025, 2026. How much they will have to pay for in terms of increased borrowing costs, right, is a question mark here. So this is something I'm quite concerned about for this company. Right, so yeah, I don't think there's too much to say about these listed funds, right? So these, they are stakes in the listed funds, right? So CICT is something familiar in our channel, right? Capitaland Ascenders REIT, right? Escort, Capitaland China Trust, right? This underperformer. Okay, Capitaland India Trust, this one is holding up well. Alright, Capitaland Malaysia Trust, right? So these are the respective percentages they own, right? Surprisingly quite low in terms of Ascenders. Yeah, so I think new economy, right, is the part that includes assets like logistics, alright, because that's how they define it in the Capitaland China Trust. Yeah, lodging is something that they seem to be quite happy with, right? They talked about it quite a lot in their report. The performance seems better this year, right? So yeah, I think we sort of discussed this somewhat, right? So this part of their report that I will just summarize as much as I can, right? So they have China Data Center Fund, right? So these are some of the funds they have, and I think data center should be okay in China, even in China, right? So, but you can see that this is one good thing they did in December 2023. I assume it's 2023 December. They divested 95% of their stake in this building, alright, and they continue to manage and generate fee from the asset. I think this is what they actually really want. They want to be asset-light, right? So they don't want to hold on to the building, right? They just want to own a small part of the building, maybe 5%, and then they do the management and earn the management fee. And this way, they don't have to worry about the debt and so on and so forth, right? So this is the part where they say that they have a record year of income-related earnings of 331 million and highest number of property openings with 9,600 units turning operational. Right? So yeah, I think they want to double the fee revenue from this Escort Limited to more than 500 million by 2028. Yeah, so commercial management is the resilient part of their business, right? A proven and resilient fee contributor, right? Derives most of its recurring fee income from asset and property management. Yeah. Yeah, so they want to expand their services to cater to third-party owned commercial properties, right? So I think this is a good idea, right? So that means to say that, like, they may not own these buildings, but they actually go manage it, right? So this is a good thing because they don't have to come out with money and take on debt to go and own the building, right? Owning the building is troublesome. They just want to manage it, then take the management fee because they are the supposed experts in this area, right? So I think I won't talk about this. I think we sort of discussed this already earlier, right? I don't think this is so important as well. Okay, so with that, I'll end this initial first look, right? I cannot say I understand this company very well. So again, none of this is investment advice, and thank you for listening.